Welcome to this brief update on the tech sector from the DNB Fund Technology. We'll touch a bit on the victims and also the beneficiaries of the AI trade. Over the long run, the reason to be invested in technology has been that it's the key driver of productivity growth in the economy. That's fueled superior earnings growth, which has again fueled superior returns. Over the last few years, the only thing that's mattered is generative AI. And the market has consistently underestimated how much capital we're willing to devote into chasing superintelligence and creating the best artificial intelligence models. The largest American companies like Amazon, Microsoft, Alphabet, and Meta are spending tens and hundreds of billions of dollars in trying to seize the opportunity in generative AI. The poster child of the downstream AI products is OpenAI, and their explosive user growth and their aggressive cash burn is also fueling the optimism in the space. We also believe that generative AI will be the next key driver of productivity growth in the economy led by technology. And the question then becomes, how do you create exposure to the secular shift and the secular tech shift? The poster child in the stock market has been NVIDIA. For us, the question always becomes, what is priced in by the market today? And what do we believe will happen? In NVIDIA, with a top line of about $200 billion, as infrastructure investments, because this is the downstream customers are Amazon, Microsoft, Google, it will also be OpenAI, etc. They will need returns on their investments. So that is what's fueling the $200 billion for NVIDIA. If you make assumptions on required annualized top line required by the downstream AI products from this NVIDIA top line, it's about $1 or $2 trillion. In our view, that has not been uniformly reflected in the rest of the stack. One example is that to run these systems from NVIDIA, you also need memory from players like Samsung and SK Hynix. In our view, the market has priced in $1 or $2 trillion of downstream AI revenues from the likes of OpenAI when it comes to the stock of NVIDIA, but it hasn't done so in the memory layer, like Samsung and SK Hynix, and also in the storage layer of SanDisk and Western Digital. What we've seen in 2025 is that the AI trade has broadened out. The market has realized that if we are building all of this infrastructure, NVIDIA is not the only beneficiary. To give one example, we've been the largest active owner in a company named SanDisk, which supplies storage to these infrastructure solutions. If NVIDIA will see the rapid growth that the market is expecting, players like SanDisk, Western Digital, Hynix, and Samsung are likely to benefit. On the flip side, in terms of the victims in the stock market of AI, we find the software players. The market has gotten increasingly concerned that the large language models and generative AI disrupts the software sector. In our view, the risk is much more nuanced than the market seems to be pricing in. We believe there's a seat risk, an architecture risk, and the boogeyman of the vibe coding risk. The seat risk will have likely varying impact from company to company. The seat risk is the business model and the revenue model of these software companies like Salesforce. Is they're priced on a per seat basis. If AI makes us more productive, perhaps we'll need fewer humans in customer supports, for instance. This will be a business model risk in the transition for Salesforce, but it's likely not an existential risk for them. On the architecture risk, the question becomes, does AI allow us to solve old software problems in a materially better way? The poster child for this has perhaps been Google. So in certain types of search, ChatGPT and large language models is superior to Google search. If we see this in other areas of software as well, that represents a risk to the business model of the software companies. The final pillar of the vibe coding risk is where we believe the market has overblown the risk factor for the software companies. The market seems to believe that AI will make writing code so cheap that it completely commoditizes software. In our view, it's much more nuanced. So while AI makes writing software code much more efficient, it doesn't eliminate the moat of every software company. To give a tabloid example, just because paint got cheaper that didn't mean that Rembrandt and Picasso were disrupted. Just because code gets cheaper, that doesn't mean that every software vendor gets disrupted. Software coding, the coding part of software, is a necessary evil. It's a bottleneck in the software creation process. The art of software design comes in the ideation and the thought process behind the software. What software vendors like Salesforce and ServiceNow have done is in trying to optimize the productivity in normal business functions, like in a bank like DNB. They've had thousands of customer conversations, and through that, thousands and thousands of iterations in how to design the software to more efficiently prompt me as an end user to do my job in a more efficient way. As of today, that is not changed by the coding models. What you would need is some form of superintelligence that does the entire understanding of human intent better than humans do today to completely disrupt the software ideation process. The question also about whether we will just have one chat interface and it will disintermediate all of the software applications. So rather than going into Salesforce and doing things in the application, I will have one master chatbot that does everything for me. That also seems like an unlikely extreme scenario. It's very hard for anyone to think about everything they want the software to do and convert that into text, rather than having buttons and sliders and a UI, user interface, to interact with. It's likely that when a company like Salesforce has spent 20, 25 years in optimizing their customer relationship platform, that there is wisdom in the way the UI is configured. And there is a reason that we don't just have one chatbot interface. Very simply speaking, you could replace every software application with just an email and an Excel spreadsheet. But what we've seen over the past 20 and 30 years is software getting more and more specialized, to be more and more tailored to how each and every one of us does our jobs. It seems likely that this will be true on a go-forward basis as well. And the question is less, will software companies exist? And it's more, which software companies are exposed to the architecture risk and which are not? Which companies are exposed to the seat risk and which are not? Rather than the vibe coding disrupting every software vendor. In our view, that's created opportunities in where the market has gotten too concerned. To give one example, we've materially increased our exposure to Atlassian because in a world where you don't need software developers anymore, where you won't create software, Atlassian gets hit twice as hard as everyone else. Because not only is it software, but it's software made to build more software. In our view, there's a fundamental misunderstanding in the market of what Atlassian does. It's not an end-of-the-line developer tool. It's a collaboration platform for also line of businesses to talk with the developers and the marketing, etc. And we also believe that there will be much more software used in the world going forward, and you will need Atlassian as a collaboration platform to make that happen. So in our view, there are aspects of the market where the market is underpricing the tailwind from generative AI. Examples would be memory in Samsung and SK Hynix, or perhaps in the hyperscalers like Amazon. And there are parts of the market where we believe the market is overly concerned about the disruption risk and remain opportunistic in software while we remain optimistic in the past layer of the hyperscalers, in memory, and also partially in storage. That's also reflected in the way our portfolio is made up. We are the most overweight in memory in Samsung and in the hyperscaler of Amazon. The largest absolute positions are also Microsoft, Alphabet, Samsung, Nokia, and Amazon, most of which are exposed positively to these trends relative to their valuation. Historically, that broader exposure has led to lower volatility than our benchmark and also superior returns. Thanks for listening.